Welcome everybody to our lecture on bonds and stocks. This is what we're going to cover in this lecture. First, we'll start with bonds. We want to lay out just the definitions, the terminology, lay out the cash flows, make sure we're comfortable with that. That's the first thing. Then with that in hand, we'll be able to talk about valuing a bond. We'll see that the bond cash flows look a lot like an annuity, or at least part of the cash flows look like an annuity. So we're going to lean pretty heavily on our present value material when we use the annuity formula to value bonds. Once we talk about valuation, then we'll move towards the conventions of the bond market. In particular, we'll talk about something called the yield to maturity. So in the bond market, just like in the stock market, you can see the bond prices. You can go to the stock market and see the price of Amazon, what the share price is there. You can also go and see what their bonds are trading at, if they have any bonds. You can see what bond prices are, just like you can see what stock prices are doing. So in the bond market, you see the bond price, and you also see the promised cash flows. So a bond is a contract. The company that is issuing the bond is going to say, give me money today, and I'll make these payments to you in the future. And they lay them out in the contract. So in the bond market, you see the price, and you see those promised cash flows. That allows you to infer a discount rate. Right? How do you put together a price of something, the present value of something, with the cash flows? Well, you need a rate. That rate in the bond market is called the yield to maturity. Okay, so we'll talk about inferring the yield to maturity based on the bond prices. Now, doing that, inferring the rate is a little bit difficult. We saw this in the last lecture. If you're trying to solve for the discount rate in an annuity, for example, it's very hard to do that because the annuity is a highly nonlinear function. And so trying to solve for R is tough to do. So what we'll see is we'll introduce a new trick in Excel. It's a very powerful tool called goal seek. And so Excel can solve these nonlinear equations no problem. Excel's just going to guess and check a bunch of times and find the rate that works, find a rate that sets the price of the bond equal to the discounted value of all the cash flows. And so that's a useful thing to know in finance generally. So we'll review that. Then we'll take a little bit of a detour into expected values. So a little bit of a detour into probability theory. The reason we need to do this is because of this thing called the yield to maturity. Right? It's a convention in the bond market. It's a little bit subtle. The economic interpretation is a little bit subtle. At first glance, it looks like the discount rate we saw in the present value lectures. But it's not quite that. It's a little bit different. We said that the yield to maturity is the thing that discounts all the promised payments that the bond issuer is making. Okay. That's a little bit different than what we saw in the first lecture. In the first lecture, what we were doing is we were discounting expected cash flows by an expected return. With bonds, the convention is to discount promised cash flows by the yield to maturity. So we'll see that these things can be reconciled, and that's going to help us interpret this thing called the yield to maturity. Next, we'll move to stocks. So in this class, the answer for anything is going to be you have to discount cash flows. Okay, for a stock, what does that mean? Well, the cash flows from owning a share in a company are called dividends. And so that's the cash flow. If you want to value a stock, you just have to discount all the dividends. So that's called the dividend discount model. We'll introduce something called the constant dividend growth model. Now, this is going to make an assumption about what's going to happen to dividends. If dividends grow at a constant rate, so constant dividend growth, those cash flows are growing at a constant rate forever. Okay, because stocks we think last for a long time. Kind of they're going concerns, so we don't have an end date on when the cash flows to a stock are going to end. So one way to simplify stock valuation is to just treat them as a growing perpetuity. You act as if their dividends are going to grow at a constant rate forever. That's the constant dividend growth model. If the dividends are doing that, then we have the growing perpetuity formula, and we can value them, value stocks using that formula. Okay. So see, this is going to give us a lot of good practice with present value calculations. With bonds, we're going to get practice with the annuity formula. With stocks, we're going to get practice with the growing perpetuity formula. The last thing we're going to talk about is something called the price to earnings ratio. So the PE ratio, is it's kind of called colloquially. That's something that you hear about in the financial press a lot. When anchors on CNBC are talking about valuations, for example, they will talk about them in terms of the PE ratio. You're trying to link the price to some kind of fundamental about the firm, in this case, earnings. So the price to earnings ratio is a very popular way to do that. And what we'll do is we'll see that this PE ratio can be derived from the constant dividend growth model. So when people talk about price earnings ratio, what they're really doing is they're modeling the company as a growing perpetuity, and that lets you think about the fundamentals of the company. You can think about the dividends, you can think about the growth rate of the dividends, the discount rate on the dividends, right? That all gets kind of summarized in the price to earnings ratio. So that's where we're going. We're going to start with bonds. These are the cash flows for a bond, or the promised cash flows rather. First, we have coupon payments. Now they're called coupons because in the old days, when you bought a bond, you would actually get a physical piece of paper, and the coupons could be redeemed for cash, right? So you would have this piece of paper with the bond, and then you'd get these coupons that come with it, just like you would go to the grocery store with coupons to get a free box of cereal or something. You have these coupons when you buy the bond, and you take them to the bank on certain dates, and you can redeem them for cash. Okay. So that's what these cash flows are. These are coupons that you'd have a physical piece of paper. You go to a bank at time 1, then you would redeem your first coupon and get some payment C. Time 2, you have another piece of paper that matures that has a date at time 2. So you take that to the bank and you get a coupon payment of C2. Okay, so you're getting these equal payments. They're the same each period, 1, 2, all the way up to time N. They're made at scheduled intervals. So typically it's semi-annual. That would be twice per year, but you could think of bonds that have an annual coupon or quarterly coupons, what have you. So those are the intermediate cash flows. At the very end, at time N, you get another cash flow, F. F is the principal. Okay. It's repaid at the last date. So you get all these intermediate coupons, and at the last date, you also get the principal payment back of F. So that gives us all these promised cash flows from time 1, 2, all the way up to the very end of the bond. You're getting C, 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 and then finally you get C plus F. As I mentioned before, this is a contract. So when you buy a bond, the company is promising to make these payments. Some other terminology we'll see. The maturity date, that's when the loan matures and it's completely repaid. So in this example, time N here has some date associated with it. That would be the maturity date. The term is how much time is left until repayment. So again, how far into the future is this N here? Is that 1 year out, 2 years out, what have you? The face value, that's F, right? We said that was the principal repayment. It's usually a lump sum that occurs at the very end of the life of the bond. Typically, it's $1,000 in the US. It doesn't have to be 1,000, but that's the convention here. And we talked about coupons. These are those regular payments that you're getting before the maturity of the bond. Next, there are important rates, the coupon rate and the yield to maturity. Now, both of these things are quoted in annual terms. That's going to be important to remember later on. I'll just foreshadow it here. The coupon rate is how much you're earning in coupons during a year, divided by the face value. So you could be getting paid twice per year. So you sum all the coupons up that you're getting in the year, and you divide that sum by the face amount, by that principal payment F. That gives you the coupon rate. The yield to maturity, we've alluded to earlier. This is the rate of return if the bond does not default. So if the bond makes all of those promised payments that, in the contract, they're promising these cash flows to you. If they actually give those to you, then your return on the bond is the yield to maturity. This is also quoted annually. Now we should have in the back of our head, this is a little bit odd because this is the rate of the return if the bond does not default. Well, the bond, it could default, but just keep that in mind. For now, this is the return if it does not default. We said that this is what connects the price of the bond to all of those promised payments. If you discount all those promised payments by the yield to maturity, that's what gives you the price of the bond. And then there are things called zero coupon bonds. These are useful to think about. It's just a bond that pays no coupons. So if we go back to the cash flows here, you could replace all of these coupons with zero. That's perfectly fine. You can write a contract that says, all I'm going to do is pay you the face amount at time N, and I'm not going to pay any coupons before then. So that would be a perfectly fine contract. There's bonds like that, so we will talk about them. So we've laid out the cash flows. We got this constant payment C made at regular intervals for a fixed period, time N, and then we've got the principal payment at time N as well. To value these cash flows, we need a rate. Right? So we can go back to our week 1 material on present value. You got the cash flows, you need a rate. The yield to maturity is that rate. It's going to be the rate that discounts these promised cash flows to give us the price of the bond. Okay. So let's go through the bond valuation next. We have the cash flows. We're going to introduce a rate. Well, how do you discount cash flows? With the rates, it's just like we do all the time, right? So the value of the bond is the discounted value of all the cash flows that the bond pays, right? So we get a coupon at time 1, a coupon at time 2. We're just discounting these by the yield to maturity, coupon at time capital N minus 1. And then finally, we get a coupon at time N plus the face amount at time N. Okay, so these are all the cash flows. And this is just week 1. We're discounting each individual cash flow and then summing them up because we know present values are additive. So the total value of the bond is the discounted value of all of these cash flows. Now, if you look at this, you'll see that this looks a lot like an annuity. At least the coupons look like an annuity. The coupons are constant payments C made at fixed intervals, and they have an end date. So those are the 3 criteria for an annuity. So we can use the annuity formula to simplify things. If a bond has a lot of coupons, you don't want to wear your calculator out by discounting each individual coupon. It's much easier to just use the annuity formula. So this would be the bond formula rewritten as an annuity here if the payments are made on an annual basis. So the bonds are the discounted value of all of the coupons, where the coupons are an annuity. And then we add the principal payment, F, at the very end. So you see that this F, that doesn't fit in the annuity. Right? The annuity, you need to have a constant payment, C. F is not the same as C, so F is something separate. So we just need to treat it separately. It's got to be its own thing. So it's sitting off by itself here with the annuity. So let's go through some examples, make sure we're okay with the mechanics. We're going to start with a very simple zero coupon bond here. We're going to get rid of coupons, just focus on valuing the principal amount here. We need to find the price of a $1,000 face value zero coupon bond that matures in 5 years with a yield to maturity of 6%. Okay, so we're starting as simple as possible. It's a zero coupon bond. So that means all those coupons are zero. So we can fill out this little table here where we've got the timeline of all the promised cash flows. There's no coupon at time 1, 2, 3, 4, 5, 0 coupons. The only cash flow we have to worry about is the principal repayment, F. That occurs at time 5, matures in 5 years, and F is $1,000. That's typical in the US. So the only cash flow is $1,000 at time 5. So how do we value this? Well, we have a discount rate of 6%. So we can discount that cash flow just like we can discount any other cash flow. The price of the bond is going to be the face value divided by 1 plus the yield to maturity raised to the 5th. Okay, so 1,000 divided by 1.06 raised to the 5th. Okay. And if you plug that into your calculator, you'll get 747. Now we're going to add a little bit of complexity. For the next example, we're going to have coupons. So we need to find the price of a bond. It's got a $1,000 face amount, just like the last example. It pays coupons annually, and it matures in 3 years. The coupon rate is 7% and the yield to maturity is 6%. Okay, so now we go back to our cash flow table. It matures in 3 years, so I can get rid of time periods 4 and 5. Nothing is happening here. Time 4, nothing's happening. All right. We still have that $1,000 face amount that occurs at time 3. So we have a $1,000 cash flow at time 3. The new thing is coupons. So how do we figure out what's going on with the coupons? Well, we have to remember that the coupon rate is the amount of coupons that you're getting each year divided by the face amount. Okay, so let me write that out. The coupon rate, the annual coupons divided by F. Okay. So we're given the coupon rate here of 7%. 7%, that's got to equal the annual coupons divided by F, which was given at 1,000. This is going to let us solve for the amount of coupons that we're getting. Okay. In particular, you can just plug that into your calculator, and you see that the annual coupons is equal to $70. Now, the bond is paying coupons annually. So we solve for how many coupons we're getting each year. We're getting $70 worth every year. The coupon's only paying once per year because it says it's an annual bond over here. So those $70, that's the size of each payment. Each payment is going to be 70. So time 1, we're going to get 70. Time 2, we're going to get 70. And time 3, we're going to get 70 as well. This is in addition to the principal repayment of 1,000. We get the $70. Okay. So we have the cash flows. We have a yield to maturity of 6%. We know that we just discount the cash flows by the yield to maturity to get the price of the bond. So that's what we'll do next. Just like any other stream of cash flows, discount them to the present. So that first $70 gets discounted once, then twice, then the 1,070 gets discounted 3 times. You can plug all that into your calculator and get a value of $1,026.74. Now you could use the annuity formula here, the bond pricing formula. You could summarize all of these coupons, 70, 70, 70, put that into an annuity and value that, and then separately value the $1,000. You could do that. We'll do that in another example. But if you only have 3 cash flows, it may just be easier just to plug them all in one by one. Okay. So now I want to add one more layer of complexity to the bond pricing, and this will be about as complex as it's going to get in this class. What happens if the bonds are paid more frequently than once a year? In example 2, you're getting paid once a year. In example 1, you didn't get coupons at all. Okay, so what happens if you're getting paid, say, twice a year or 4 times a year? We have to make a slight adjustment to our bond pricing formula. Okay. The issue is the conventions of the bond market say that the yield to maturity and the coupon rate are all quoted annually. Okay, so again, we're calculating the number of annual coupons that we're getting. The yield to maturity is quoted annually. So if you want to use this discount rate, you need to adjust it, right? If you're getting paid every 6 months, say, you don't want to discount a cash flow 6 months out by an annual rate, right? So suppose you've got a 3-year bond. If you have an annual discount rate and you discount the times 6 cash flow, you're getting 6 cash flows for a 3-year bond paid semi-annually. You don't want to discount that last cash flow, that 6th cash flow that occurs 3 years away. You don't want to discount it 6 times by the annual rate. You want to discount it by a lower rate to reflect the fact that that 3-year bond is, the last payment on the 3-year bond is only 3 years away, not 6 periods away, not 6 years away. Okay, so what are we going to do? We're just going to make a very simple adjustment. We have to divide the yield to maturity by the number of payments that you're getting per year. Okay, so we make a slight adjustment to our bond pricing formula. Anytime we had a yield to maturity before, we just divide by the number of payments per year. Okay, so I didn't want this to be the first formula that you saw for bond pricing because it looks pretty ugly, but just know it's the exact same thing we saw. It's an annuity here plus the discounted face value. The only difference is the yield to maturity has to get cut because each cash flow is arriving more frequently than once a year. So you can't use an annual rate to discount stuff that's occurring more frequently than that. Okay. C is still going to be the size of each individual coupon. So C is now going to be what you're getting every 6 months. It's not going to be what you're getting every year. It's going to be what are you getting each time you get to cash in the coupon. And N is still going to be the number of coupons paid. Okay, so if you've got, again, if you've got a 3-year bond that's paid twice a year, N is going to be 6 because you're getting 6 coupons. Okay, C would be the size of each one of those 6 coupons. And then the discount rate here would be the annual yield to maturity divided by 2. Okay, so let's just do an example, make sure we're on the same page here. This setup is going to be the exact same as example 2. We're still going to have a $1,000 face value bond. We're still going to have a coupon rate of 7%, and we're still going to have a yield to maturity of 6%, and the bond is still going to mature in 3 years. Okay, everything is the same as the example I have over here in the Word document. The only difference is the coupons are paid semi-annually. Okay, so you're getting paid twice per year. So how many periods do we have? How many N, right? Well, how big is our N? Well, it's a 3-year bond, and we're getting paid twice per year. So that means we've got 6 periods now to deal with. Okay? So I'm going to lay out the cash flows. I'm going to add on rows to the right. So this is how many periods we have. Okay, we'll start with the easy cash flow. That's the face value. We're getting that $1,000 at the very end. So that's occurring at time 6. We don't have to think about that. That's always just occurring at the very end, that $1,000. The other cash flows we have to deal with are the coupons. Now remember, the coupon rate is quoted annually, always. This bond is paying more frequently than annually, but the coupon rate is quoted annually. So the coupon rate of 7% here means you're getting those same $70 every year. Just like before, we're still getting $70 per year. The difference now is that $70 is paid over the course of a year, over 2 payments. You're getting paid twice per year. So that means that each coupon is going to be the annual coupon divided by the number of payments per year, which in this case was 2. So we have $35 per year in coupons. So time 1, you're getting 35, that's 6 months out. In a year, you're getting another 35, 18 months, 2 years, 30, 2.5 years. And then at time 6, you're getting the coupon as well, in addition to the face amount. Okay. So we have the cash flows, we have the timing of the cash flows. The last thing we need to do is get the rate. So what discount rate do we use in the bond pricing formula? Well, we have a yield to maturity of 6, but that's an annual rate. Just like the coupon rate was annual, the yield to maturity is annual. So what we need to do is discount the yield to maturity by the number of payments per year, N. So we have a 6% rate divided by 2 payments per year. So that's a 3% discount rate. So that's everything we need. Now we just plug everything into our bond pricing formula. We have an annuity of $35 every 6 months, and then we have the face amount. So putting all of that together, again, you could spell out each of those 6 cash flows, but that's a bit tedious. The easier thing to do would be to use the annuity formula here with the individual coupon being $35. The 6-month discount rate is 3%. And then you add on the face value, which is occurring in 6 periods from now. That gives you $1,027.09. Last example here, we're going to, again, change everything up, make sure that we're comfortable with the notation and plugging things into the annuity formula. So here, we don't even have the same face amount. This is a European denominated bond, so we don't have the $1,000 face amount that you typically get in the US. Now we've got a €200 face value. It's paid semi-annual coupons. So that's a little tricky. It's got a 10-year term, a 4% coupon rate, and a 9% yield to maturity. Okay, so what do we do with all this? Well, first thing, you always want to get the cash flows. So this bond, it's got 10-year term, and it's paid semi-annually. So how many payments do we have? Well, you have the number of years times the number of payments per year. That tells you how many periods you have, okay, which is pretty intuitive. In this case, you've got 10 years, and you're getting paid twice per year, semi-annual, so you've got 20 periods. Okay, so we have to modify our table here. I'm gonna just add some ellipses here. Something happens between times 2, and then we're gonna go periods 19, 20, 21. Okay. What are we getting at time 20? Well, that's the maturity date, so we're getting the face amount, 200. That's F. Okay. And then after that, nothing. Time 21, nothing happens because the bond is matured. Okay. So that's the easy part. Now we have to figure out the size of each coupon. Well, we go back to this equation. We know that the coupon rate is the number of annual coupons that we're getting divided by F. In this case, we're given the coupon rate of 4%. And we know F is the 200 euros. Okay, so that means that each year we're getting 8 euros in coupons. Now that's annually. These coupons are paid twice per year. So therefore, the size of each coupon is 8 divided by 2. Remember, so that's 4. How did we get that? That was the annual coupons divided by the number of payments per year. You're going to pay twice per year. So we're getting these little 4 euro payments every period from time 1 up to time 20. Okay. The next thing we have to do, because these are 6-month payments, we don't want to use a 1-year discount rate, so we have to modify our R. So we have 9% divided by 2, so the discount rate we're going to plug into our bond pricing formula is 4.5%. Now we pull up the bond pricing formula. We know that the bond is going to be the present value of all the coupons. How do we value the coupons? So C divided by R, which in this case we're going to use 4.5%, times 1 minus 1 over 1 plus R raised to the N. So this first term is going to value all the coupons. Then we're going to add the face amount. So we did all this work already. We know what the coupon is. It's going to be 4. We know what the discount rate is going to be. It's going to be 4.5. We figured out N is 20 periods away. And then we have to add the face amount of 200 divided by 1.045 raised to the 20th. So it's a lot of work to get there. We have to manipulate each little piece of the formula. But once we did that, we just put it into the formula, crunch it into our calculator, and we'll get about 135 for the value of this bond. That brings us to the yield to maturity. So now we figured out the mechanics. We worked through a few examples. This is going to be as complicated of an example as we're going to see in this class. You had to divide the coupon, you had to divide the yield to maturity, you had to keep track of the number of periods. Okay, so if you can do this example, then I think you're in pretty good shape. Next, I want to talk more about the conventions of the bond market and try to figure out what this yield to maturity is really, right? It's a little bit different than a discount rate that we've seen before. So we want to make sure that we're on the same page on how we interpret a yield to maturity. So what happens in the bond market? Well, we said that a bond is a contract. So a company writes that contract. In that contract, the company is going to specify the face amounts, the maturity of the loan, as well as the coupons. Okay, so basically the company is writing a contract specifying all the cash flows and how long those cash flows are going to persist for. That contract then gets traded. Just like in the stock market, shares of equity get traded. In the bond market, these contracts get traded. And so you can see the price. You can see the price of that contract at any given time by looking in the bond market. If we have the cash flows in this first bullet and we know the price, the only thing missing is the yield to maturity. So this is what gets inferred by looking at the price and the cash flows. Right? That's a fancy way to say that is that the yield to maturity is the rate that rationalizes the price and the bond's characteristics. Right? It puts those two things together. If you've got cash flows and you have a price, you need a discount rate to kind of connect them. That's what the yield to maturity is doing. Okay. So let's talk about how to find the yield to maturity. We'll do it for a zero coupon bond first, and we're going to see that it's actually pretty straightforward to do for zero coupons because if you have a zero coupon bond, you only have one cash flow. So let me show how that works. Okay. So suppose you've got, let's get rid of all this old stuff we were doing. Let's say you've got a cash flow at time capital T, say. And nothing after that, so it's just zero coupons, nothing up until time T. Okay, so here's the promised cash flows. You look in the bond market and you see these cash flows for a zero coupon bond. Okay. Now, how would we discount these normally? If we go back to week 1, well, you've got one cash flow. It occurs at time T, and you see the price of that cash flow. So we know how to value stuff using just the present value formula. The present value is equal to the cash flow that you're getting divided by 1 plus R raised to the T. So to find the yield to maturity, all we're going to do is solve for R. Right, if you just have one cash flow, you can do a little bit of algebra to solve for the discount rate. How would we do that? Well, I'm just going to walk through this step by step because this is probably the most algebra that we'll have to do in this class is to solve for R in an equation like this. The first thing to do is to multiply both sides by the denominator here. We want to, what we're shooting for is to solve for R. So we want to get R by itself in a numerator somewhere. We don't want it in a denominator. We can't do anything with it there. So we're going to move it to the numerator by multiplying both sides by 1 plus R to the T. So that's what we're left with. We get rid of it in the denominator here. Instead, we move it on to the left. Well, what do we want to do next? We want to get 1 plus R by itself. So we're going to get rid of this present value. We want to move that away from R. So we're going to divide both sides by the present value. Divided both sides by the present value. Now we've got R over here. The issue now is that it's in this parentheses, and this parentheses is raised to the T power. So how can we get rid of that T? We need to separate that T away from the R. To do that, we're going to raise both sides to the 1 over T power. Okay, so let me show you that. So we had 1 plus R to the T, and further we're going to raise that entire thing to the 1 over T power. What that's going to do is that's going to neutralize that T. We're going to get rid of it. It's going to be T times 1 over T, which is just 1. So we're going to be able to get rid of that T on the left-hand side. And that's going to equal to C divided by the present value, also raised to the 1 over T. Okay. So to simplify, we're left with 1 plus R is equal to C divided by PV raised to the 1 over T. Now we're almost there. We just have to solve for R. So we subtract 1 from both sides. Okay, and that's it. That's how you solve for R in our day one present value formula. Okay. So how do we do this with bonds? Well, all we're going to do is we're going to replace the day one terms with our bond terminology. Okay, so what's the price of a bond? What's the present value of a bond? Well, we called that B. So let's, we're going to substitute, basically, we're going to substitute everything we have from the day one into something that looks like a bond. So the present value is the bond price, B. The cash flow, C. Well, what is that for a zero coupon bond? It's just F. That's the only cash flow that we're getting for a zero coupon bond is F. Okay. T is the same. We've got some time period in the present value formula. We've got some time period for the bond cash flow, so that's the same. And then R, that's the yield to maturity in the bond market. That's not a discount rate in the bond market, it's a yield to maturity. So that's how I got this equation on the slides. It's just the yield to maturity is equal to the cash flow, F, divided by the price of the bond, which is the present value of those cash flows, raised to the 1 over T power minus 1. Okay, so if you're looking at the bond market and you're looking at a zero coupon bond, you know the promised cash flows, you know the price, so you should be able to solve for the yield to maturity. So here's an example. What is the yield to maturity of a bond that has $1,000 principal amount face value? Zero coupon bond, it matures in 7 years, and it's currently selling for $823. Well, we would just run through the present value formula, essentially, solve for R, which is what we did with the formula and the size here. Plug in the cash flow divided by the present value raised to the 1 over T minus 1. We would get 2.82% would be the yield to maturity on that bond. Okay. Now, more generally, however, it's going to be very difficult to solve for the yield to maturity. So we're not going to do it in this class. If you've seen the IRR, which we'll see next week when we cover kind of complementary measures to NPV, the internal rate of return acts very similarly. The internal rate of return is the thing that sets NPV equal to 0 for a stream of cash flows. And so for our stream of cash flows, for a bond, you've got the price of a bond, and then you've got all these promised cash flows. So the IRR would be the discount rate that makes those things equal to each other. So the NPV would be 0. Okay. But for our purposes, mathematically, there's not an easy way to calculate the yield to maturity or the IRR if you have more than 2 cash flows. Okay, here we've got 2 cash flows in our example because we had the face amount and we had the price of the bond, B. So those are the only 2 cash flows. With 2 cash flows, you can solve for the yield to maturity. But more generally, if we're looking at the bond pricing formula here, if you've got a lot of different cash flows, then you're not going to be able to solve for the yield to maturity. Okay, you can see what's going on. You've got the yield to maturity here. You've got the yield to maturity raised to the nth within this bracketed term. You've got another yield to maturity to the nth here. So what's going to happen is you're going to have all of these terms raised to different exponents. You're going to have a term that has YTM raised to the nth. You're going to have a term YTM raised to the n minus 1, to n minus 2, right? It's going to be a very messy nonlinear equation to solve. So we're not going to worry about doing that kind of algebraically in this class. However, you can use computers to do that. So if you know Excel, or if you have a financial calculator, if you have some IRR function, you can use that to find the yield to maturity. So for example, if we're in Excel, we have this IRR function. We're going to take this, this example where we have coupons now. So it's not a zero coupon bond. It's going to be a lot harder to solve for the IRR. We can't do it analytically. We need a computer. This bond has a $1,000 principal amount. It matures in 5 years with semi-annual coupons. Okay, so now we've got, over 5 years, you've got 10 coupons to worry about. That means that trying to solve the bond pricing formula would have, terms 10 different terms raised to the yield to maturity to different powers. So it'd be a mess to solve this analytically. We've got a coupon rate of 5%, and we know that the current price is $8.78. So how can we find the yield to maturity for this bond? Well, the first thing we're going to do is just draw out the cash flows. Okay, make sure we're set on the cash flows for this bond. And then once you figure that out, then you can use like an IRR function. But it's helpful to lay out the cash flows for any problem first. Okay, so if it's 5 years, semi-annual, that tells us that N is going to be 5 years times 2 payments per year. So that's going to be 10. We're going to have 10 periods to deal with. The face amount is 1,000. So we're going to have a $1,000 payment at time 10. There's a 5% coupon rate. So what does that tell us? That means that the annual coupons are going to be 5% of the face amount. So we have a 5% coupon rate. See what's the annual coupons divided by 1,000. Therefore, we're getting $50 in coupons every year. Now it's paid semi-annually. So how much are we getting paid every 6 months? We're getting 25. And then finally, at time 10, we're getting $25 plus the $1,000 face amount. So those are the cash flows. Now we need to find the IRR. That's the question. That's the question here is finding this yield to maturity, which we know is a IRR. So how could we do that? Well, we could use this IRR function in Excel or on your financial calculator. How many payments do we have? Well, we figured that out. We've got 10 payments. What's the size of each payment? We figure that out. It's 25. Okay. What's the price of the bond? Well, that's given as 878, so that would be B. And what's the last payment that we're getting? That's F. That's $1,000. Okay, so you can plug all of that into your calculator to get an IRR of 4%. Okay. Now here's a little bit of a trick. Remember that the yield to maturity is quoted annually, but these coupons are occurring every 6 months. So you have to keep it straight in your head. Each of these periods is 6 months. So the discount rate that works here is a 6-month rate. So let me write that down. If we have a 4% IRR here, this is a 6-month rate because these are paid semi-annually, coupons. So what's the yield to maturity? Well, the yield to maturity is quoted annually. So therefore, the yield to maturity is the 4 times 2, right? The 2 payments per year. So that's 8%. So that's a little bit of an annoying part of the bond convention is everything is quoted annually. So you have to keep track of that in your head. Okay. So that's how you would find the yield to maturity for this bond. This is what is happening in the bond market. Everybody is quoting prices in terms of the yield to maturity. Okay, so you wouldn't say this bond is trading at 878 necessarily. Kind of the easier thing to do would be to say the yield on this bond would be 8%. That's the convention. Everyone talks in terms of yields rather than in terms of prices. The reason is the yields are kind of a nice summary statistic for the bond. This price here of 878, that's a function of all the other characteristics of the bond. So that 878 is coming from the face amount, how long it is in the future, and the coupon rate. So all of that gets summarized into the price. And so you can have 2 bonds that are paying the same yield, but the prices are very different just because the coupons are different, for example. And so in the bond market, it's very hard to keep track of all these different levers that are moving with different bonds. Okay, so GE could write a 0 coupon bond and a semi-annual coupon bond. that look the same, but maybe they would have the same yield because GE is issuing the bond, so they should have kind of similar risk characteristics. They could have the same yield to maturity on those two bonds, but the price of the zero coupon bond is obviously going to be a lot lower than the price of a bond that has coupons, because you're getting the cash flows earlier if you're getting coupons. Okay, so that's why the yield to maturity is a useful statistic. Everyone quotes bonds in terms of the yield to maturity, not necessarily prices. So next I want to show a new trick in Excel called goal seek. I like Excel because you get to break the cash flows down into pieces. You get to see kind of the nitty-gritty of what's happening with these calculations. So we're going to do it for this example here. We already drew out the cash flows. I'm just going to lay those out in Excel and show how you can use Excel to solve these nonlinear equations. Okay, so for any nonlinear equations, obviously the IRR function is already built into Excel, but you can have Excel solve any nonlinear function that you want, and so that's a nice trick to have that should come in useful, as you're setting up models in Excel. So let me pull up the spreadsheet we got. So this spreadsheet is up on Blackboard, or it's on Teams rather, in that folder, the class materials folder, Excel practice dash discounting and CAPM. So that's where all the other content is. I'm going to walk through the cash flows for this bond and show how we can use this tool called goal seek to find the yield to maturity for the bond. Okay. So first thing, anytime you want to set things up in Excel, we're just laying out the ingredients. We're laying out the data. So for this bond, what do we need? Well, we need to have the timing of the cash flows, the size of the cash flows, and a rate. We did this already with the present value stuff. These are the three ingredients for any present value calculation. Okay. So for this bond, we've got 10 periods. We already solved for that. Right, 10 cash flows, so I'm going to lay out 1 through 10. Just as a review, how do we do this in Excel? What tricks do we use? Well, we tell Excel to write a formula. We do that by entering the equal sign. So equal, now Excel knows it's a formula. How are we going to add 1 to all of these numbers and get numbers 0 through 10? We're going to tell Excel to look at the previous cell, A2, and then just add 1 to it. So it's looking at the 0 in A2 and adding 1, so we get 1. Then I'm going to tell Excel to do that for all the cells below it. So I'm going to fill down by hitting Control D. I highlight all the cells below this formula, and then I hit Control and the D key at the same time, and it fills down that same formula. So what's happening all the way down in A12 now? Well, A12 is looking at the value in A11 and adding 1 to it. Okay, so we already did this. What are the cash flows? I'm just going to copy what we had in the Word document here. You're getting $25 every period. Fill that all the way down until maturity, in which case you're getting the $1,025. Now the rate, this is what we're going to solve for, right? Where we have to solve for the rate. We did it using the built-in function before, but I want to show how to do it a different way. So for now, I'm just going to guess. I'm going to guess the rate is like, 5%. And so that's my input. What I'm going to do is I'm going to tell Excel to apply that 5% rate to all of these cash flows. So how am I going to do that? I'm going to use a formula. I'm going to tell Excel, pull a rate from cell C2. Okay. I'm going to fill that formula down. So this first rate here in cell C2, that's the key. Because if I change this, I change it to 6%, say, the rate for all these other cash flows is going to just automatically change because all these other cash flows are referencing C2. Okay. C3 is referencing C2, C4 is referencing C3, which is referencing C2, right? So everything goes back to this, this yellow highlighted cell. So we have the ingredients for the present value calculation. Now we just need to calculate the present value of each of these cash flows. So we already did this. What's the present value? It's just the cash flow that's sitting in B2 divided by 1 plus R that's sitting in cell C2 raised to the time period. So again, equals the present value formula. That's all we're doing there. You're going to fill that down. So what's going to be the price of the bond? If this is our rate, 6%, how do we value the bond? Well, we've got all these individual cash flows. We got the value of each individual cash flow. I'm just going to sum up all those valuations. So the price of this bond, if our rate is 6%, is going to be $742. Okay. Now, what's wrong about this? Well, what's wrong is the price, right? We were guessing on the rate, and the rate would imply a price of $742. But if we go back to the slides, we already know the price. The price is $878. So I can write that here. The true price of the bond, that's just given in the problem, is $878.34. So the problem is these two numbers are not the same. We guessed, and when we guess a rate, we get a price of $742, but we know that the true price is $878. So that means that our guess was wrong. Okay. So one thing we could do is just guess and check ourselves. So 6% is giving us a price of $742. That's too low. That's lower than $878. So what does that mean? If our price is too low, it must be that our discount rate is too high. Right? We're discounting those cash flows too much, and that's pushing the price down. So this rate must be too high. I'm going to lower this a little bit from, say, 6% to 5%. Okay, so now the rate goes down. That means all these present values go up, which means the total price of the bond goes up. Right? What's nice about setting it up, if you can set it up in a smart way in Excel, everything happens just automatically. You just change your one number in yellow over here and see what happens to your bottom line, the price of the bond. So that's useful to just be able to play with. Here we see that the price went up, but it didn't go up by enough. Right? The price is still, the implied price is still below the true price. So we know that this rate is still too high. So let's say we cut the rate down again from 5% to 3%. What happens to that? Well, now our price goes up to $957. Now we shot too much. Our rate's too low. That means the price of the bond is going to be too high. We shot past this $878 and went all the way to $957. Okay, so as humans, we can kind of guess and check a little bit. Eventually, you'll settle on 4%, and there you go. The implied price of the bond is pretty close to the true price of the bond. Okay, now 4% is a pretty easy number to kind of hone in on. It doesn't always have to be so easy, and so we don't want to be guessing and checking a million times to figure out what the right rate is that sets the implied price of the bond to the true price of the bond. What can we do is we can use a computer to do all that guessing and checking for us. Okay, so let's do that. That's the goal seek tool. I'm going to move this. Let's just move this to 10%, say. Okay, so we're way off. I want to show how you can use Excel to do all this guessing and checking for us. Goal seek is within the data tab. Okay. In particular, it's under this what if analysis section over here. So what if analysis, what does that mean? What if I change something? What's going to happen? Right? That's what if evokes. With goal seek, what we're going to be doing is we're going to be changing this rate. And we're going to see what happens when we change this rate that's highlighted in yellow. Okay. So click on goal seek. There are 3 parameters that Excel wants to know: a set cell, a to value, and by changing cell. So set cell, that's our bottom line. That's the number that we want to change. We want to set it equal to something. So that's those first 2 cells. We want to set something to something else. So what do we want to set? We want to set this implied price of the bond, this $539. That's wrong. We know it's wrong. We want to set it to the right price. How do we do that? Well, we put something in this to value here. In this box, we put the true price, this $878.34. So this is the logic in Excel. We're telling Excel, change cell G2, make it something different, make it equal to 878. Excel can say, oh, I can do that. That's fine, but you have to give me some flexibility. Excel has to be able to change some stuff in order to hit the right number for cell G2. So what does Excel allow to change? We're going to allow Excel to change the rate in cell C2. Okay, so that's the logic. We want Excel to get this implied price to the correct price by giving it some flexibility to change the rate. Okay. You're going to click OK and see what Excel does. So watch closely. Here goes. Okay, so you see that there's a whole bunch of guessing and checking. Excel tried to, I don't know, hundreds, thousands of different rates. It can do it in the blink of an eye. If you look really closely, you can see it happen a few numbers, and then it converges on a number. It gets very, very close to what we want. This 878.34 is pretty close to what we need. How did it do that? Well, it converged on 4%. It figured out that at a rate of 4%, the implied price is going to be the true price. Okay, so that's very useful because you can do this for any nonlinear function that you want. Obviously, you can use IRR if you have a particular set of cash flows, but look at how limited the IRR function is here, right? You have to have a constant cash flow, times C here. You have to input the cash flows into the function. The form here is a bit limited. With goal-seek, we can write any function we want. You can have, exponentials. You can have, natural logarithms of something else times, I don't know, pi. Is that, yeah? So there's a pi function, right? So you can have any function that you can dream of, some nonlinear function, times the square root of something else, and you can choose to set this nasty nonlinear function equal to whatever number you want, right? So that's what's really cool about goal-seek is nonlinear functions aren't a problem for Excel. It's just going to guess and check a million times to find the number that you want it to. Okay. Now I want to take a little bit of a step back. We've talked a lot about the conventions of the bond market. I want to connect those conventions back to what we did with the present value lecture. If you remember from present values, all the way back to the first thing we did was we defined the present value function, right? The present value is equal to the future value divided by 1 plus r to the t. We said that this future value was what we expect to happen at time t. We expect to have some cash flow at time t, and r is our discount rate. That's what we expect to earn on an investment with that risk. Okay, so you discount these expected cash flows by this expected return. Now, what have we been doing with bonds is we've been looking at promised cash flows, right? These are contracts that bonds are writing. They're promising to make these cash flows. That's different than an expected cash flow, right? And likewise, we've been using this thing called the yield to maturity. That's the return you get if the bond does not default. So if the bond hits all those promised payments, your return will be the yield to maturity. Okay. So these are a little bit different. These should be kind of bothering us a little bit. So we need to step back and connect these two. Okay. To do that, we have to take a little bit of a detour into probability theory. We have to review expected values. And so that's going to happen next, but keep this issue in the back of your head. Keep this divergence between what we've done in the past and what we've been doing today. Keep that in the back of your head. We're going to come back to this and reconcile these two and learn about this yield to maturity a bit more. We're going to figure out what this means economically once we can review expected values. Expected values are an average, and averages can be a little bit weird. So here's a little excerpt from a book, a children's book I sometimes read to my kids at night. It's called The Phantom Toll Booth. All right, so this guy here, Milo, he's the protagonist. He's goes through some toll booth, a phantom toll booth, and that takes him to this adventure land, this fantasy land where they learn about numbers and words. Okay, in this case, he's climbing some stairway to infinity, and he runs into an interesting character. Okay, so pardon me for staring, says Milo after he had been staring for some time, but I've never seen half a child before. Right, there's that half of a child. Well, it's 0.58 to be precise, replied the child from the left side of his mouth, which happened to be the only side of his mouth. Oh, we're just the average family, he said thoughtfully. Mother, father, and 2.58 children. And as I explained, I'm the 0.58. But averages aren't real, objected Milo. They're just imaginary. Well, that may be so, he agreed, but they're very useful. For instance, if you didn't have any money at all, but you happened to be with 4 other people who had $10 apiece, then you'd each have an average of $8. There are still other advantages. For instance, if one rat were cornered by 9 cats, then on average, each cat would be 10% rat and the rat would be 90% cat. If you happen to be a rat, you can see how much nicer that would make things. But that can never be, said Milo, jumping to his feet. Well, don't be so sure, said the child patiently, for one of the nicest things about math or anything else you care to learn is that many of the things which can never be often are. Okay, so we're definitely going to take that view here. Averages are weird, but they're very useful. And so in finance, that's often what we're using, is we're using some average that can never be, but it's still very nice to, a very nice way to summarize what could happen. When we have something that's random, for example, like a cash flow, the cash flows we deal with are often random. We don't know exactly what's going to happen, but we have some expected value. We know, we have some sense of what it is going to be. Okay, that's the expected value. We're going to calculate the expected value as an average. Okay, it's the weighted average of the outcome, where the weights are given by the probability of each outcome. Okay, so the easiest way to see this is with an example, right? We have some variable x, it's got 5 possibilities. Could be 100, 75, 64, 20, or 0. These are the 5 possible outcomes. These are the probabilities associated with each outcome. It'll be 100, 25% of the time. It'll be 75, 25% of the time. It'll be 64, 15% of the time. It'll be 20, 30% of the time. And 5% of the time, x will resolve to be 0. So what is the expected value of x? Well, we're going to calculate an average, the weighted average of these outcomes. Okay, so it's an average of these things where the weights are given by the probability. So we multiply each outcome by its probability and then sum all of those up. Okay, so 100 times 0.25 plus 75 times 0.25 plus 64 times 0.15 plus 20 times 0.3 plus 0 times 0.05. That gives us an expected value of 59.35. Now, why are expected values weird? Well, we'll never get 59.35, right? This is the rat that's cornered by 9 cats example, right? 59.35 is not one of these possible outcomes. However, that's what we expect to happen in a statistical kind of probabilistic sense. We expect 59.35. Okay. And so that's what we're going to use in finance. We're going to use the expected value, like an expected cash flow. So let's turn back to finance here. Go back to our day 1 formula, the present value formula. The present value is equal to the cash flow divided by 1 plus r to the t. Now we said c is usually not guaranteed, right? So this is a random variable like x in our previous slide. X is random, we don't know what's going to happen. C is random too. That was kind of implicit when we put in this discount rate. We said there's some risk associated with C. We don't know what it's going to be. That's why we needed to discount it by some kind of risk-adjusted measure. So we know it's random. So if we want to be more careful in how we write the formula, we should really write it like this, where the present value of a cash flow is what we expect the cash flow to be, discounted by the expected return on an investment with that risk. Now, we're not going to write it like this. Everyone else writes it the more simple way, PV is equal to C. This gets a little bit clunky with all the expectation operators floating around here. So it's a little bit clunky to write it here, but this is the more precise way to write it. This is what we mean. We mean the expected values. So we really, if we want to be careful, we should be writing the expectation operators. So let's do an example on finance. Think about an investment that's going to pay at time 1. Okay, so you just have one cash flow that occurs at time 1. So it's about this most simple example that we can think of, but we're going to use expected cash flows. The investment's going to have a $60 payoff with a 25% probability, and it's going to have a 100% or $100 payoff with the probability 75%. Okay, so 2 possible outcomes. One cash flow could be 60, it could be 100. Okay. We have a discount rate of 12. So what is the value of this investment? Well, what we should do is we need to first value, we need to first get the expected cash flow. So how much are we expecting? Well, 25% of the time we're going to get 60, 75% of the time we're going to get 100. So the expected cash flow is going to be 90. We're never going to get 90, but that's what we expect to get. Okay. Again, the language here, the kind of colloquial use of what we expect to happen doesn't map very well into the probabilistic sense of that word, right? We expect to happen, 100 in the colloquial sense, because that's the most likely outcome is 100. So you could say we expect to get 100, but that would be wrong when we're talking about probability here. We expect to get 90 because that's the weighted average. Okay, so that's something to keep in mind. Whenever we talk about expected values in this class, we mean in the probabilistic sense, not in the more colloquial sense. Okay. So we have one cash flow. We expect it to be 90. We have a discount rate of 12. So what's the value of this cash flow? We're just going to discount the expected value by the rate to get 80.34. So now we've reviewed expected values. We've reviewed probability. That's going to let us get back to bonds. Okay. Remember, we said bonds are a little bit weird. What we've been doing is we've been discounting promised cash flows by this yield to maturity. What we should be doing, back to the day one of class, should be discounting expected values by an expected return, not the promised cash flows by the return if there's no default. Okay, so what's going to happen here? Do we expect to get all of these promised cash flows? Well, not necessarily, right? What could happen to a bond? If a company is writing a contract saying that they're going to promise to give you these cash flows, what could happen? Well, they could make all the promised cash flows, in which case you would get the yield to maturity. Okay, that happens if the bond does not default. But obviously that's not the only thing that could happen. Sometimes you get cases like this.
I declare bankruptcy!
Sometimes you're going to run into a Michael Scott. You're going to run into someone who just, for whatever reason, they can't pay their debt. Companies can't pay their debt all the time. Municipalities can default as well. So that means that the yield to maturity is a little bit subtle. We need to discuss this. There's going to be two ways to think about valuing a bond. We have the convention in the bond market, which is to discount the promised cash flows by the yield to maturity. And then we have our week one material, discount an expected cash flow by the expected return. Now, why is this the convention? Why is one the convention in the bond market? Well, you can see the promised cash flows in the bond market. And so everyone can refer to these things. Everyone knows what these are. It's a little bit harder for people to talk about expected cash flows because maybe the probability of default is different, or you're not sure what the probability of default is. So it's a little bit harder to talk about things in terms of expected cash flows, whereas promised cash flows, those are written down, everyone sees those. So it's kind of a useful benchmark to have. Okay, so number one is the benchmark is the convention in the bond market. We're going to compare that to number two, which is what we really should be doing, what we do normally with present values. Okay. So the best way to see the difference here is to do an example. Okay, we're going to see how these two things can be reconciled to each other and relate them to each other. So consider the case of the financial crisis, right? AIG is in big trouble. AIG wrote a lot of insurance on subprime debt. So if, this was 12 years ago by now, but there was a lot of these subprime mortgages that got into trouble during the financial crisis. AIG wrote insurance on these. So if those if those contracts are in trouble, AIG has to pay out a lot of money because they wrote insurance on the subprime mortgages. So in order to help themselves, AIG wants to issue bonds. They want to issue 1 year 0 coupon bonds with a face value of 1,000. That's about the simplest bond that you can think of. Now, they're in big trouble, so you don't expect that they're going to be able to pay with any kind of guarantee. In fact, you only expect that they're going to be able to pay off the bond with probability 50%, and otherwise you'll get nothing. Okay, so because of this, you're willing to pay $400 for the bond. Right, so we have the price of the bond, we have the promised cash flow, and we have what we expect to happen. We're going to be able to use this information to calculate the implied discount rate and the yield to maturity. Okay, so these are different concepts, right? The discount rate is what we would use in week one. discount an expected value by the expected return. That's the discount rate. The yield to maturity is what you get if there's no default. So these are two very different rates. We're going to see exactly how they're different in this example. Okay, so let's pull up the Word document here. We're going to value this bond two different ways. Okay. We're going to value it first using the conventions of the bond market. We're going to discount promised cash flows by the yield to maturity. So the price of the bond, in this example, you just have one cash flow. So what is promised here? The promise is the $1,000 face amount. Okay. What is the price of the bond? Well, you know the price of the bond is $400, and you know that the promised cash flow is $1,000. That occurs in 1 year, so you discount the promised cash flow by the yield to maturity to get the price. That's going to let us solve for the yield to maturity. Do a little bit of algebra. We see that 1 plus the yield to maturity here is equal to 1,000 divided by 400. That's going to tell us that the yield to maturity is equal to 150%, basically. 2.5 minus 1, so that's 150%. This is the return you get if AIG actually pays off on the bond. Okay. Now, as we said, we don't expect them to pay off on the bond. So let's value this bond using a different method, where we're discounting the expected cash flow by the expected return. Well, we know what the bond price is. It's still 400. Now, what's the expected cash flow in this example? It's not the promised cash flow, obviously, because there's a high chance that the bond will default. The expected cash flow is going to be $1,000 that they promise, but you're going to only get that 50% of the time. And the other 50% of the time, you get nothing. Okay, so the expected cash flow is only 500. Okay, that's the weighted average of the promised cash flow. Okay. You're weighting the cash flows by the probability. 50% of the time you get 1,000, 50% of the time you get 0. So the expected value, right, is 500. We're going to divide that by 1 plus the discount rate, R. That's going to tell us that 1 plus R, just doing a couple steps of algebra here, is going to equal 500 divided by 400, which tells us that R is going to be 25%. The yield to maturity, on the other hand, was 150. So economically, we should use this example to understand the yield to maturity a little bit better. The yield to maturity is not what you expect to get, right? You should never expect to get 150% return. That, you know, you're getting scammed if someone is promising you 150%. So what is the yield to maturity picking up? The yield to maturity is picking up both the discount rate, both the expected return, as well as the probability of default. Okay, so there's two things going on in this 150%. One of them is this 25%. That's what you expect to get. That's kind of economically, how much of a return should you get based on the risk that you're taking? That's 25%. The yield to maturity is much higher than that because the yield to maturity is also baking in the probability of default. So if you see a bond with a really high yield to maturity, that means that there's probably a high chance that the bond is going to default and you're not going to get the promised payments. Okay, but this 25%, that's a more reasonable number. That's kind of what you would expect to earn taking risk in the financial crisis. You're taking a lot of risk here, so you should get a decent return. You're not going to get 150%, but you should get a decent return. Okay, so this is how we can reconcile what we did with week 1, where we're discounting expected cash flows by expected returns here. We can reconcile that in the bond conventions by discounting the promised cash flows by the yield to maturity. We just have to know that the yield to maturity has to be higher to compensate for the fact that the promised cash flows are not the same thing as the expected cash flows. So to make the price equal, the yield to maturity has to go up. Okay. Another case where this shows up, we'll talk about toward the end of the class, is with venture capital. So VC funds, what they do is they raise money to invest in small startups. If you think of all the big tech companies, Microsoft and Hewlett-Packard and PayPal and Google, Facebook, they all started with venture capital money. Now, those are the success stories. So if a venture capital company invested in one of these companies, they made a huge amount of money. Most of the companies, 95% of the companies that VCs invest in, however, don't earn any return for the VC. They get nothing back. They lose money for most of those. So how can a VC handle this high chance of failure? Well, VCs use very high hurdle rates when they discount cash flows. Okay, so they'll use hurdle rates of like 100 or maybe 150% like we have here. They use really high hurdle rates when they're discounting future cash flows. They do that not because they expect to earn 150% when they make an investment. They do that because they're maybe expecting to earn 25%, but they know that the vast majority of their investments are not going to pay anything at all. Okay, they know that there's this big wedge between kind of the best case outcomes. When they discount cash flows, they project these best case. What happens if my company goes to IPO and I get these really good cash flows? Okay. They know that those cash flows are much higher than kind of the average, what you would expect to happen. So because you're forecasting these best case cash flows in VC, to compensate for the fact that you may get nothing, you have to use a very high hurdle rate. Okay, so the logic is going to be very similar. We'll talk about that again toward the very end of this class. One powerful way to think about stocks is as growing perpetuities. Okay, so first things first, how do you value stock? Well, you value stock just like anything else. You discount the cash flows. What are the cash flows called for a stock? They're called dividends. If you buy a share of Samsung, Samsung's going to pay dividends to you. That's what you care about. That's what sets the value of the stock. So you can value the stock. You can calculate the present value of all those dividends to find the current price. This is called the dividend discount model. It's nothing different than what we have seen. You're just discounting cash flows. So the price of a stock is going to be the discounted value of all the future dividends. DPS here is the dividends per share. So if you own one share, you're getting these dividends per share, and it's a sum from one period into the future into infinity, right? All those future dividends, anything that the company may pay, you care about, that shows up in the stock price. Now the issue is, how do you know what the dividends are going to be? It's very hard, right? It's very hard to forecast, especially because a lot of the value comes far, far into the future. For a lot of companies, you think about Microsoft, for example, it's famous because for a long time it never paid any dividends. And then it finally started paying big dividends in the early 2000s or so. So it's very hard to guess when the dividends are going to come in some cases, and it's hard to know what's going to happen for infinity, right, with those dividends. One approximation that turns out to be pretty powerful is to assume that dividends are going to grow at some constant rate G. This is just going to help us fix ideas and think about the drivers of stock valuation. If the dividends are growing at a constant rate G, then that means that the dividends are a growing perpetuity, and that means we can use our very elegant growing perpetuity formula to get a handle on their valuation. Obviously, this works best for stable, relatively stable companies. Again, if it's a tech startup that hasn't paid any dividends, then this kind of approximation is going to be particularly crude. For stable companies, it's going to work better. That brings us to the actual formula. How would you value a company under the constant dividend growth model? Well, this should look very, very familiar to you. This is the growing perpetuity model. All we've done is we've substituted stock lingo, stock words into the growing perpetuity formula. Instead of a present value, we have the price of the stock. That's P0. What's the price of the stock today? Instead of a cash flow at time one, now we just have a dividend per share. Instead of a generic discount rate, we have the discount rate on the equity. So we subscript this with E to reflect the fact that stock is a claim on the equity of the company. So this is the expected return on the equity. And then G is the growth of the dividends. Okay, so formula's the same, just like we just took new words in the bond section and applied them to the annuity formula. Now we're taking some new words in the stock section and applying it to the growing perpetuity formula. Okay, so let's just go through some examples, make sure we're okay using this little constant dividend growth model. So company C is expecting to pay a dividend of $3 per share next year. And we expect that those dividends, they're going to be paid annually and they're going to grow at 2% forever thereafter. The discount rate on the equity is 6%. So what is C's current price? We're just going to walk through the perpetuity formula. Right? We have present value is equal to the cash flow divided by R minus G. We have all that information at our disposal. We know the current dividend is going to be $3 per year, discount rate of 6, growth rate of the dividends is 2. So that allows us to figure out share price of $75. Okay. We'll do a slightly more difficult example here. Now we're going to think about the growth rate. We can use our very simple model to think about the growth rate for the dividends, and that's a useful metric to have as well. So in this first example, we were solving for the price. But oftentimes, you look in the stock market and you can see the prices for companies. There's a ton of price data that's available. You can use this constant dividend growth model to infer, say, growth rates. If you see the price, you can think, what must be the growth rate that rationalizes those prices? How can we make sense of this price? How much do dividends have to grow? Because you can see the stock price and you can also see the dividends that companies are paying. That's all publicly reported. So if you can see the dividends and you can see the stock price, then you can back out the other piece of the puzzle, which is the growth rate on the dividends. And so let's do that for the second example with Microsoft. So Microsoft is declaring a dividend, its first dividend in January of 2003. The stock price is currently $55. The dividend per share is expected to be 16 cents next year. That's the first dividend. We're going to assume that a discount rate of 25% applies to Microsoft's equity, and the dividend is going to grow at a constant rate G. So we can solve for the G that rationalizes these prices. Okay. How are we going to do this? Well, first things first, we set up the cash flows. We know that it's a growing perpetuity, so that means we know we can use this formula. The dividends per share at time 1 get discounted by RE minus G. Okay. We look in the stock market, we see Microsoft's stock price is $55. Put that in for the P. We see that the dividends per share 1 year ahead are going to be 16 cents. Okay, so we have that. Further, we see that the discount rate for the equity is 25%. That's the expected return you expect to get when you hold Microsoft's equity. Okay. What we don't know is G. We need to find the growth rate in the dividends that makes sense of all this. So all we're doing is applying the constant dividend growth model to Microsoft stock. We're going to do a little bit of algebra just to solve for G. I want to make sure that you've seen this at least once if you haven't already. We're going to multiply both sides of this equation by the denominator, 0.25 minus G. I want to solve for G, so I want to get that out of the denominator. How do I do that? I multiply both sides by this thing to kill the denominator here. Okay. That leaves us this 55 times 0.25 minus G is equal to 0.16. Next, I want to get the G term by itself. So I want to get rid of that 55 thing. I want to get rid of that 55 term. I want to try to get the G by itself. So I'm going to divide both sides by 55. almost there. Now I need to get rid of this 0.25. So I'm going to subtract 0.25 from both sides. And last thing I need to do is I need to get rid of this negative sign. So I'm going to multiply both sides by -1. That's going to give me G is equal to 0.25 minus 0.16 divided by 55. That works out to be about 24.71%. So what's interesting about this is you could do this for Microsoft. You could also do it for a bunch of other companies during the tech bubble, and you would get weird numbers. You'd get super high implied growth rates for a lot of the companies that ended up going bust, right? If you think about this, the stock valuations in the stock bubble, they're very high and then they crashed later. What was weird about those valuations is that they implied super high growth rates on the dividends. These companies were not paying much in dividends, so the only way to rationalize the high prices was to assume that there's going to be a lot of growth going forward. And so like I said, this is kind of a useful benchmark to think about what does the price imply about the growth in the dividends. This is also something that shows up on the quiz 2, where you've got a pretty standard present value formula, but you're not solving for the present value. You look and you see the stock price. You're not solving for that anymore. You're solving for something on the right-hand side of the equation, something like a cash flow, or in this case, a growth rate. So this is a common technique. Hopefully you practice and get used to the algebra. So where does the discount rate come from? We mentioned with this constant dividend growth model, we've got a little bit of a special discount rate here. This is the return on the equity, right? So it's not just the return on the assets, it's the return on the equity itself of the company. So for now, we're just going to take that as given. In words, it's what you expect to earn on the stock. If you're an investor, you need to get compensated for the risk that you're taking. And so in an efficient market, your expected return on the equity is going to be equal to this cost of capital. Okay. Later on, we'll talk about this in much more detail. We'll use something called the CAPM to try to measure the discount rate on the equity more precisely. But for now, just know that if you have dividends, which are the cash flows to equity, you need to discount those cash flows by the risk to the equity, right? You always have to link the cash flows to the risk. And so if the cash flows are for the equity and dividends, then the discount rate has to be the discount rate on the equity as well. Okay. Let's do another example. Company B is going to pay a dividend of $11 per share next year, which is going to grow at 3.2% thereafter. The expected return on the stock is 10.4%. So what is the company's stock price? Well, this is just like the first stock valuation we did. We want to find the price. We know what the dividend's going to be. We know the discount rate on the equity, and we know the growth rate on the dividends. So we're just plugging all this into the perpetuity formula, working through to get $153. Okay. Let's do one more example with a twist. Okay. So we're going to take this very simple example, and we're going to push back all the cash flows. Okay. So let's insert, let's just look at the cash flows for this first one, and then we'll see how it changes. So we have the time periods, 0, 1, 2. Then we've got the dividends. That's the cash flow. We were getting $11, and then $11 times 1.032, and that was going to continue forever. Okay, so we're going to have a constant growth in those dividends. Did this, we got a price of 11 divided by 0.104 minus 0.032, which is equal to about 153. Okay. Let's add a little bit of a twist to this example. Let's say that the dividends are delayed. So instead of getting dividends at time 1, now we don't get anything for 4 years. For 4 years, you just get 0 dividends. And then in 5 years from today, then things pick up again. Now you're going to get that $11 per share starting at time 5 instead of time 1. Everything else is the same. We're still going to grow the dividends at 3.2% after that, and we're still going to have that discount rate on the equity of 10.4%. Now we have to find the price for the stock. Okay, so let's modify the cash flows over here. Let's go on the right. Now instead of getting cash at time 1 and 2, you don't get anything until time 5. Okay, at time 5, you get 11. At time 6, you get 11 times 1.032. Okay. At times 1, you get nothing. Time 2, you get nothing. You get nothing up until time 5. Okay, so time 4, you're still getting nothing. And then times 6 and on, things are growing at that constant rate. Okay, so how can we think about this? Well, we know that it's a growing perpetuity starting at time 5. It starts paying at time 5. So this is where we have to remember, it's still a growing perpetuity, so we can still use this formula. The problem is the growing perpetuity is no longer a present value anymore. Before, we got paid at time 1, so the valuation was sitting at time 0. That's why we could calculate a present value for that stream. However, if the cash flow doesn't start until time 5, then this valuation of 153, that's sitting at time 4. It's sitting one period before those cash flows start. We have a special stream of cash flows starting at time 5. That's a growing perpetuity. We know how to value the growing perpetuity. We just need to remember that the valuation is sitting one period before the growing perpetuity starts. Okay, so we spell that out here. The price at time 4, if the stock is going to be a growing perpetuity starting in time 5, price at time 4 is a growing perpetuity. Okay, so the price at time 4 now is going to be 153. This problem is asking for the stock price today. What is the price today of all of these cash flows? Okay. Well, what's the value of the cash flows from time 1 to time 4? Well, you're not getting any cash flows, so the value of that should be 0. The only cash flows you have to worry about are at 5, 6, and through infinity, and those are summarized here. Those are summarized in the price of the stock at time 4. So all we need to do is discount this valuation that's sitting at time 4. We just need to bring that back to time 0. We need to bring that back to the present. Okay, so that's going to give us the present value. The stock today is where the stock will be at time 4, discounted by 1 plus R to the 4th. Okay, so we have this 153 valuation. It's just 4 years out though, so we need to bring it back to today. And if you do that, you get about $103. Okay. So this is another case where the shortcuts can start in the future. And so it's very important to know when the cash flows start and where the valuation is sitting. In this case, the valuation is sitting at time 4. Now, if we wanted to be, I want to be a little bit more careful here, just so you're not confused when it comes to like a quiz problem. If we want to think about the price at time 0, it's possible that you are actually getting cash flows at times 1, 2, 3, and 4, and then the growing perpetuity kicks in at time 5, right? So if we wanted to be more general about this, how could we think about the price today? It would be the dividends per share that you're getting at time 1, discounted by 1 plus RE, plus the dividends per share that you get at time 2, discounted by 1 plus RE squared, plus the dividends that you're getting at time 3 divided by 1 plus RE cubed, plus the dividends per share at time 4 divided by 1 plus RE to the fourth. And then finally, the dividends at time 5, 6, 7, 8 through infinity, those are all summarized by the price at time 4. Okay, so what we can do is put that into the present value calculation. So this would be the more general answer. How do I find the price of the stock today? Well, I need to value all the dividends. These are the first 4 dividends that I'm valuing. In our example on the slides, those were all 0. So we didn't have to worry about those at all, right? All these first 4 dividends were 0. So we didn't have to do anything. However, we still have to get a handle on the dividends at time 5, 6, 7 through infinity. Those are all captured by P4. Okay. So we can discount that back 4 times to get the price today. Okay, so 1 second, please. 1 second.
Wow, the big was a mini with.
Now there is a caveat to using this constant dividend growth model. It's pretty intuitive, but the basic idea we talked about is that sometimes it's hard to know what's going to happen with dividends. And so when you're treating things as a growing perpetuity, it's a very rough way to value a company. It'll give you a handle of some things that are important, but it's not going to be very precise. So for example, I pulled up some examples here. You can go to the Wayback Machine on the internet. You can see what Netflix, what their stock or what their website looked like in 2003. So I can pull that up here. And what have we got here? Sign up now. You got a big mailbox here. You're getting videos through the mail. You just sign up and choose your movies, get them in the mail, free shipping. They'll return them. No late fees ever. So that's something that we all worry about, is having late fees. Featured in Good Housekeeping and Time Magazine, because again, we all read these things nowadays. Okay, things have changed a lot, obviously. For Netflix, you would not have predicted the way things have gone. So, using a very simple measure like the constant dividend growth model, it's not going to work very well. Likewise, you can think about Apple. So Apple released their iPhone in 2007, June of 2007. So here's what their website looked like in August. So right after they released the iPhone. Okay. Very prominent, putting right up on the front page there is iMac. Now, I don't know anyone who had an iMac. I'm sure some people I knew did. I never had one. But that was the main thing that Apple was pushing at the time. After that, you get this iLife down in the corner, new iLife, new iWork, oh wait, okay. And then you finally get to the iPhone, right? Say hello to the new iPhone. That's the little square in the bottom right of the website. So what's happened since then? Well, the iPhone has dominated, right? The iPhone has been the main thing that's driven Apple's success. So you go to Apple's website now, what do you get? Well, you get iPhone first thing right up front, and you get more about the iPhone 11. And then you get iPad Pro. So maybe it's kind of like a computer. It's not exactly. It's closer to the phone probably than the computer of the iMac days. Then you go down and you get more tablets, AirPods, right? Things that are very different. Right? You would not have anticipated this change from the iMac and whatever these other things are, the iLifes, to the iPhone. In fact, Apple didn't even anticipate it, right? Apple is not putting a lot of emphasis here on the iPhone. They were pushing this iMac, but they couldn't see that the iPhone was going to be the big source of all their growth going forward. It's just hard to know these things. Okay, so that's all just a caveat that this constant dividend growth model, it gives you a rough handle, but obviously there's nothing precise about it. Okay. Another thing that the constant dividend growth model gives us is something called the price to earnings ratio. The basic idea here is we want to link stock prices to some fundamental of the company. So that's earnings, right? The earnings is an accounting measure of what the company is actually doing. The stock price should be connected to that. If the PE ratio deviates from kind of what you would expect, if the PE ratio for Apple, for example, deviates from the PE ratio of Samsung, then either that means that Samsung and maybe Apple is special. Apple is different than Samsung in some ways, even though they compete on a lot of the things. If the PE ratios are different, then something must be different about them. Or it could be that one of the companies is overvalued. Or maybe it's an emotional thing. Everyone gets emotionally attached to the iPhone, investors do, and then they push the PE ratio up. Okay, but the point is, this gives us some way to think about what's driving stock prices. We're going to link the PE ratio to the constant dividend growth model to think about the drivers of stock prices. Okay? So don't worry about this kind of derivation here. I'll just walk through it real quickly. Again, you don't have to worry about this for a test or anything. The idea is we're just starting with the constant dividend growth model. Okay, so we've seen that growing annuity of dividends. Then we're just going to divide both sides by earnings per share. Right? Just like you can get dividends per share, you can cut up the dividends that the company pays on a per share basis. You can do the same thing with the accounting earnings. Okay. So I'm going to divide both sides by earnings per share at time 1. I'm going to divide the dividends per share by the earnings per share. Okay, and that's it. I'm going to rewrite things just a little bit. I'm going to take this top thing, DPS over EPS. That's what fraction of your earnings are you paying out in dividends. So sometimes that's called the payout ratio. Right? What fraction of your earnings are getting paid out as dividends? That's called the payout ratio, say at time 1. Okay, and that's it. We took our very simple growing perpetuity formula. We divided it by earnings. That gave us the PE ratio. And we see there's basically 3 drivers of the PE ratio, 3 fundamental drivers. Right? There's the payout ratio. So if a company, let's say Apple, is paying more of their earnings in dividends than Samsung, that means that would drive Apple's PE ratio higher than Samsung's. If you're paying out more in dividends, that's a good thing for investors. You're getting cash earlier, so the valuation should go up. Likewise, this discount rate on the equity is going to be one of the drivers. So if Apple has a lower discount rate on the equity than Samsung, that too is going to drive the PE ratio higher for Apple than Samsung. Okay. So one way to think about this is the risk of Apple's equity. If Apple has less risky equity than Samsung, then the price of Apple should go up, right? When the discount rate goes down here, denominator goes down, that means the fraction goes up. Same idea with the growth rate. If Apple's dividends are growing faster than Samsung's dividends, then that too is going to push up the PE ratio. Okay, so we can have a very simple model to think about the fundamental drivers of stock prices. And this PE ratio gets used all the time. You turn on CNBC, you'll hear it all the time. People use it to talk about, you can compare companies, you can compare Apple to Samsung and try to get a sense of why is Apple's PE ratio different from Samsung's. Or you can compare stock prices over time so that you can think about the S&P 500, for example. You can look at the stock price for the S&P 500 relative to the earnings of the S&P 500. And the PE ratio gives you a sense, well, are things more overvalued today than they were maybe last year or 10 years ago, something like that. And so that was the starting point for the PE ratio. There's a Yale economist, Robert Shiller, who first started studying this. He looked at prices, dividends, and earnings for the S&P 500 for a very long time series, going back from like 1871 to 2017 is what is on his website currently. You can pull this off of his website. If you look at prices in green and you can look at dividends in red, you definitely see the relationship here. There's kind of some variation in dividends, and these variations here show up as variations in the stock price. However, what Shiller noticed is that the dividends are pretty smooth. The stock prices are fluctuating more, kind of substantially more, than the dividends. So now what did he conclude from that? He concluded something along these lines, that there's just these animal spirits, that stock prices just swing up and down. They're not connected to the cash flows, so things are just swinging back and forth because of our emotions, right? So animal spirits are different than the spirit animal sometimes you see on memes. It's about the emotions driving stock prices. That was Shiller's take. But we know, because we studied the constant dividend growth model, that there's something else that could be changing over time. It could be the discount rate on the equity that is also changing. And if this changes a lot, then that would also show up in the PE ratio. That would also show up as changes in the PE ratio. Okay, so we see dividends could be part of it, but because dividends are smooth, that means there must be a lot of action in the discount rate on the equity. So let's just show the PE ratio over time. This is again from Shiller. The green and the blue are the PE ratios. He computes them slightly different ways. But those are the PE ratios. And then the red line are long-term interest rates over time. That's plotted on the right axis. The PE ratio is on the left axis. Here, we definitely see a relationship with interest rates. So as R goes up, prices go down. Right? So R spikes in 1981, for example. That means that valuations on stocks have got to go down because all those future dividends are worth less than they would have otherwise be with lower interest rates. Okay. We also see that interest rates do fluctuate quite a lot. Okay, so potentially this is one of the reasons that kind of a fundamental reason why the stock price can move beyond just what's happening with the dividends. This doesn't solve the dilemma. Obviously, a lot of this variation could be due to emotion or could be due to these animal spirits, but at least we can think a little bit more formally about the fundamentals that could be driving stock prices as well. Okay, so that's all I had to say about this. I will talk to you next week. All right, bye.